Hello and welcome back to FT Markets. Now, we're all understandably braced for a very alarming weekend. The news from Greece is very concerning and there's obviously a risk of a true serious financial accident here in Europe. But should we really be more worried about what's happening in China? That's the contention of our markets editor, Mike Mackenzie. Now, Mike, okay. Shanghai Composite is down roughly 30% in a matter of weeks, but it's still up more than 70% on where it was a year ago. And of course, Westerners are still barely allowed to hold this stuff. The direct contagion from this into the rest of the world has to be minimal. Can you really say this is a greater cause of worry than the possibility that the euro itself is about to disintegrate?
Absolutely. I think
really?
China has been the big investment story for more than a decade. We've had a massive commodity price boom, which has now come off. But again, China has really been the focus of everyone's hopes for the future economy. It's going to mold the global economy, massive investments in places like Africa. A lot of the real estate booms around the world have been fueled by Chinese money. So the key thing here is, yes, the stock market has dropped a great deal in the last 3 weeks. It's still up 70%.
Yes.
But we're now at this potential tipping point because this week was the first time we saw aggressive actions from the Chinese central bank essentially being ignored by the market.
Okay, so what did you find more alarming? The fact that the central bank felt the need to act, or the fact that the market felt able to ignore it?
I think both, and I think what's really interesting here is that you're seeing increased signs of panic from the Chinese authorities. We've gone from a rate cut last weekend and dropping the reserve requirements for the banks. Now, it normally is, wow, off goes, the market goes to races.
That's the kitchen sink right there.
That's the kitchen sink.
Yes.
That doesn't work. Market drops like 7% on Monday and then came back a little bit, but it was still down. So then they roll out, okay, let's tweak the margin requirements. They've also sort of announced various other measures, but it's having no effect. And then today, of course, they're now saying they're going to investigate and go after market manipulators and people who are selling shares short. Well, hang on, the biggest market manipulator is the Chinese authorities themselves. We know they've asked their state-owned enterprises to come in and buy shares this week, which they have been doing. But the thing here is that if you had that, the fact that prices are still up 70% means people are still sitting on good profits. If they came in early to this rally, they need to go and sell futures to essentially insure themselves or insure their portfolios against further losses.
So are you arguing here that the authorities are actually doing exactly the wrong thing, that they're going to do something counterproductive?
I think it's counterproductive, and you're preventing markets from working in any sort of reasonable, fairly, sort of market efficient way, although we are talking about China here. But you're really making it difficult for people to not simply turn around and pick up the phone or go to their app and say, hit the sell button,
Okay.
I'm out.
Now, we all know that the stock market is famously bubbly. It did nothing at all for many of the years of the great expansion in the beginning of the last decade. Then it suddenly went bananas in 06 and
Yes.
07. So even if there is becoming a more mature stock market, we do know that this is a poorer indicator than it would be for many other economies. Are you concerned about the underlying Chinese economy? What are the indicators you're looking at to tell you to worry there?
I mean, if you can sort of look at a whole host of anecdotal measures such as electricity consumption. You can look at how, again, the efforts by the Chinese authorities to keep the wealth effect from higher stock prices. That tells me that they are worried about the economic growth. They're worried about the economy slowing. We've seen a pronounced drop in commodity prices. Iron ore took a tumble.
Renewed one recently,
and a renewed
as well.
one this week with iron ore starting to tumble again. And again, you've now got people expressing a negative view on the Australian dollar because that's seen as a proxy to trade China weakness. And I think the backstory here is that the economy in China is slowing down. It's probably slowing down a lot more than what Beijing is willing to admit, and hence the kitchen sink approach. Because in a way, this stock market bubble has been created because China was worried about a slowing economy, and so they started cutting interest rates. And again, that money hasn't gone into the economy, it's just gone straight into the stock market.
Now, final question though, we've spent many years talking about what happens if there's a Grexit. It's reasonable to be very scared about what might happen in the very worst scenarios there.
Yes.
What is the worst case scenario we're talking about with China?
Well, essentially, it's been one of the engines of global economic growth. And if that shuts down or it just slows down, then it's very difficult to see how the US economy can achieve escape velocity. And meanwhile, coming back to Europe, here's Grexit. I mean, people in Europe have been quite confident this year was, QE was working under Mario Draghi. We've seen some optimism in the growth numbers here. But if China really slows down, what happens to the German export machine, which relies on Chinese buyers? You're talking about a very nasty hit to global growth, and it's one of those unexpected hits that no one really wants to talk about, but that's what upsets global markets across the board.
Okay, Mike, thank you very much indeed. In conclusion, I've enjoyed trying to be devil's advocate, but I completely agree. I've spoken to 2 economic consultancies in London this week, both of whom think that Chinese growth could actually go negative. People generally think of anything below 5% growth as a hard landing for China. It's very concerning, and really, yes, I do agree, ultimately it's more worrying even than the situation in Europe.